Stocks, they are jumping after the better than expected April jobs report, with the S&P 500 on track for its longest winning streak in more than 20 years here. Joining me now for much more on this conversation, we've got Andrew Briggs, Stewart Partners Wealth Advisor. Andrew, you have some tips for investors to keep in mind this month. Where should they start?
Sure. Thanks for having me. Obviously, I hate to use the word uncertainty that keeps getting thrown around, but the way we've putting that message towards clients is that at the beginning of the hot word was obviously U.S. exceptionalism, and that's now migrated towards uncertainty. So as both the inflation prints this week, some of the jobs data, the numbers this morning kind of highlight, is backward looking wise that U.S. exceptionalism is still in play, both from a corporation side on the earnings front and now even on the consumer side with the hot labor market. So with that being the case, like I said, it's too many unknowns at the moment to make any knee-jerk reactions to disrupt a full-on financial plan and what the objective of that portfolio is. And so currently, reminding clients obviously that long-term equities typically go up, and could be a lot more damage to be had by not being invested.
And so with that in mind, where are the areas within the U.S. exceptionalism trade that have held up the best and are worth perhaps layering into those positions?
Sure. So, I think one part of the U.S. exceptionalism trade that up until April, took a little bit of a breather was the Magnificent Seven, which, again, prior to any Liberation Day announcements, coming into January, we were a little cautious on the earnings expectations in general, not just on the Mag 7, but, many of the corporations out there. So frankly, given the sell-off that a lot of those have had, and now that we've got a somewhat clarity with first quarter earnings for most of them, I would say that is an old U.S. exceptionalism trade that, still is in the early innings from that standpoint. And, given the runway of AI and obviously the continued CapEx that they continue to put in that space. So, that's one area I would say. The second thing is, again, given what I would call the secular changes that have taken place that we can get into, but essentially we do think regardless, even before tariffs, that this is going to be a higher interest rate, higher inflationary environment. So that does change the complexity of clients' portfolios where it can't be just so simple as equities and bonds. We think there needs to be some additional levers in there to weather times like this in any future on the horizon.
And so, Andrew, as you're thinking through what we've seen already over the course of this earnings season as well, what is the playbook? What is the expectation? Is there enough that we've heard to really kind of give some inclination as to what is going to be the continued trend over the course of this earnings season, which much of it has been just the lack of clarity that CEOs are citing that's led some of them to either lower their guidance or say, hey, you know what, we're not confident reaffirming our full year guidance at this juncture, but hopefully we've got some more updates to give in the near future.
Sure. So, obviously similar to the macroeconomic data we already kind of discussed, same thing on the earnings front. Obviously, they are backwards looking. The expectation is that, to the extent these tariffs stick, obviously won't get any more clarity on those impact till at least quarter two, if not quarter three earnings. I think I would say as we came into the year, bottom up analyst expectations for essentially 14% earnings growth for the year. Those have obviously come down towards 7%, which the market is trying to price right now. So to answer your question, take that from two different views, a positive and negative. On the negative front, we do remind clients, although this isn't the base case that we have, it's not too far-fetched looking at models to essentially see that current expectations of 7% earnings come down to negative earnings, obviously, if these tariff rates get instilled or even stay at a somewhat restrictive level of 20% or plus. So that's one thing to be cautious of, although not a base case. But right now, like I said, I think that as you mentioned the word, and we keep mentioning uncertainty, because of that, we do not want to make any rash or erratic decisions in the portfolio until we continue to get more clarity from that standpoint.
So no erratic decisions within the portfolio. Does that mean that sell in May and go away is not in play this time around?
We don't think so. No. Given that, we have had a nice recovery in April, from that standpoint, which is great to see. But That certainly means we could retest some lows here, but that's not enough evidence for us to recommend selling in May and going away, as they say, particularly given the announcement last night, which everyone was really waiting to hear on the potential negotiations going on with China, which in our opinion is obviously much more driving the markets today rather than the solid jobs data. So no, like I said, we don't think it's the right decision to be timing this market. And as I said at the beginning of this call, we do think we have the proper levers in place, which whether that is fixed income, which is faring better versus the 2022 lack of diversification that provided. But again, there are some other levers, broadly speaking, which many might refer to as all the alternative space, which has held up nicely year to date. And, we think will continue to help the clients weather this uncertainty.
Andrew, thanks so much for taking the time here with us today.